Are you still there?
I'm still here, Mike.
Okay, good.
The thing that was interesting that on that major decline in gold in the that's happened over the course of September in particular is really the central banks fulfilling their quota from the central bank gold sale agreement. But the other thing is that one of the things that I believe is a long-term driver is there's just not that much more supply left in the markets.
Well, that's something that, that you found from that show, from what you were telling me before, from contacts in the industry and some figures you received.
Yeah, I was really kind of taken back by the amount of supply or the lack of supply that's out there. And we have to remember, gold's a commodity. There's a supply-demand. It's not like high-tech or we have a lot of intellectual property to put into a goodwill model. Gold is based on supply and demand, and the thing that's happened is supply is beginning to get more and more squeezed. It takes a long time for output to respond to higher gold prices, and what I mean by that is the mining industry really has to ramp up. And you have to remember this has happened in the course of 2.5 decades of a bear market where they've hedged their positions and haven't had any real incentive to really produce a lot more supply for the marketplace. The other thing is that in response to the central banks and their quotas, the central banks represent the largest single source of supply risk. But the largest gold holders are signatories of the CBGA, which is the Central Bank Gold Agreement 2. And we talked a little bit about that in previous programs. But if you really do the math and you subtract the world's total central bank gold reserves that are unlikely to be sold, there's only about 400 tons left in the float. And you got to remember that each year they have a quota of 500 tons that they're able to sell in the open marketplace.
Wow.
Now these are mostly central banks in Western countries. There's very, very little exposure. The Asian banks have very, very little exposure to gold and gold reserves. As a matter of fact, if you were to look at the Asian banks ratio, and what I mean by that is the Bank of Japan, the People's Bank of China, they only have about 1.5% of their total reserves in gold. And so they are looking much more towards increasing their gold supply, our gold reserves, than selling it out in the open market as the Western banks have sold. And there'll be a limit where Western banks, that being the Federal Reserve, the European central banks, will say, we sold all the gold we're going to. And I believe we're getting very, very close to that. In addition, we haven't seen the industry really ramp up and provide the supply that we're going to need with the current demand out there.
Well, I don't know. It could take a decade for that to happen, or even if it's even possible, because one problem is there was the bear market in gold went on for so long that a lot of these companies, just not the companies, but the whole sector as a whole, there's little capital going into it, little investment, so it's lagging behind all this demand. It takes years for exploration companies to come up with new discoveries.
It takes years for not only new discoveries, but more importantly, to put those discoveries in production isn't easy.
Yeah, exactly.
You have to remember, oil is like any other commodity. It takes, a tremendous amount of capital and a tremendous amount of time to really develop it so that you have the supply. And that's why, the economy, especially commodities, goes in cycles. But we have started to see some interesting things. Argentina, for instance, has recently shown and actually made a bid to start acquiring gold for their currency reserves. And most central banks that are smart are going to do that because they don't want a fiat currency. If you really study GATA, which is the Gold Antitrust Action Committee, they believe that the central banks don't have enough reserves there to keep the price down for an extended period of time. And from what I've seen in the non-signatories in the central bank gold agreement, it's true. The supply supply is very, very limited. And it gets more and more limited each year that this gold gets sold in the free market. At the same time, the demand is increasing exponentially. And I'll just talk very briefly about that. But we haven't seen demand like this around the world in our lifetimes, if ever. What's happened is the actual dollar expenditures on gold, whether it be from jewelry or retail, by consumers around the world has been rising very consistently. The other thing that's happened that's had a tremendous impact on gold and the demand for it is the exchange-traded funds.
Right.
You know, whether that's on the New York or other ETFs in London, Australia, South Africa. But the gold and other commodities are becoming asset classes, which is a real specific change in thought to an investor, meaning they're becoming part of a portfolio allocation.
Well, I'll tell you a real quick story. We're running out of time, but at my mom's house, I found some investment book. It was written in 1999, just a real, basic general thing, for someone who's just learning about investing in general. And it had a page in there, like it'll have a chapter about bonds, stocks, so forth. And it had one little page about gold. And it said that it was a bad investment because the only way it's going to go up is if there's a nuclear war. And then, what good would it do then, basically? So I think, the sentiment in the late 90s for gold was so bearish. And we're only starting to slowly get out of that.
Exactly. I mean, but you're starting to see this become part of an asset allocation.
Exactly. That's the digression I was making, that, no one would even conceive of it being that.
Right.
Now it's starting to get to that point,
Well, the thing that's also interesting is in just 2 years, there's over 500 tons of gold held in reserve for these ETFs. I mean, that's amazing.
Yep.
The turnaround has been significant. So the ETFs has put a tremendous demand factor in there. There's a lot more, but I think probably the biggest one, and I want to speak more about this, in subsequent programs, is the virtual revolution that's taking place around the world. You're getting deregulations, especially in China, where they had actually developed the Shanghai Gold Exchange, and individual investors can now, individual citizens can actually own gold. The investment demand in India, in new investment products in Switzerland, Taiwan, South Korea, Hungary, the amount of demand for gold happening on a global basis, whether it be central banks or individual citizens, is increasing exponentially. And that's really what I got out of the Denver Gold Forum, is it continues to go up, and it's going up, and we don't have an answer for it, which means over the long term, gold has one place to go.
That's right. That's right. Well, we'll save some more thoughts and facts that we got for next weekend.
Sounds good, Mike.
Okay.